All right, so you're here with us on the deep dive because I think it's safe to say you want to get a handle on how the financial world works.
Absolutely. And more importantly, how to maybe even make it work for you.
Right, without needing like a PhD in finance or spending all day glued to the financial news.
Right, exactly. It can feel overwhelming for sure.
It can. So today we're going to do a deep dive into the world of risk and return, looking at some of the classic strategies, but also getting into how technology is shaking things up. And we're going to try to do it all in a way that hopefully cuts through the noise.
No noise, just signal. We've got a really interesting mix of sources for this one.
We do.
We've got Burton Malkiel's A Random Walk Down Wall Street, a classic.
Seriously, classic.
Scott Patterson's Dark Pools. That one takes us into the world of high-frequency trading.
Kind of the wild west of finance these days.
Yeah, for sure. Then we've got Martin Pring's Technical Analysis Explained. This is our guide to understanding charts and patterns and trying to predict where the market might be heading.
Trying to read the tea leaves, as they say.
Exactly. And last but definitely not least, Benjamin Graham's The Intelligent Investor, the Bible of value investing.
The one that Warren Buffett swears by. So each book offers a totally different perspective on the market. Malkiel kind of tells us why beating the market is so hard.
Yeah, he makes a strong case for that.
Dark Pools shows us those high-tech battles that are happening behind the scenes.
The algorithms fighting it out.
Right. Then Pring gives us the tools to try and understand market psychology, like those crowd dynamics.
Yeah, all through those charts.
And then you have Graham. He's all about taking that really grounded, almost skeptical approach. He wants us to know what we're buying before we buy it.
He does not want you to get caught up in the hype.
So our goal here is to pull all of these threads together, see how they connect, maybe where they contradict each other, and most importantly, what you can take away from it all to become a smarter investor.
Sounds like a plan.
Uh-huh.
So where should we begin?
Well, I think the first thing any investor needs to wrap their head around is risk, right? Like, how do we even understand it?
It is the first thing, yeah.
And how do we manage it? Because, let's be honest, it's scary.
Absolutely. Investing always involves some level of risk.
Malkiel dives right into that in A Random Walk. And he actually makes this point about global markets. He says that even though everything seems so connected now, like the S&P 500 here in the U.S. and the MSCI EAFE, which tracks developed markets outside of North America.
Right. You've got Europe, Japan, Australia, all in there.
Exactly. And then emerging markets and even commodities, which are represented by the GSCI.
Right. That's the Goldman Sachs Commodity Index.
So even though all these markets are more connected than ever, he says they don't all move in the exact same way. So there's still this benefit to spreading your investments around, to diversifying.
There's still that lack of perfect correlation.
Right. And he actually gives an example. He says during that first decade of this century, 2000 to 2010,
which wasn't a great time for the U.S. stock market.
Not at all. He says that diversification still really paid off because even though U.S. stocks were struggling, other markets were doing better.
So it kind of smoothed out the ride for investors.
Right. So even in a world where everything seems super interconnected, diversification still matters.
Huge takeaway for investors.
Now, Malkiel also spends some time talking about beta.
Ah, beta. That little Greek letter that can cause so much confusion.
It can. Basically, it's this number that's supposed to tell you how much a stock or a fund tends to jump around compared to the overall market.
So like a beta of 1 means it moves pretty much in line with the market. A beta of 2 means it's twice as volatile.
Exactly. And on the surface, it seems like a pretty handy way to get a sense of how risky an investment might be. But Malkiel kind of pulls back the curtain a bit. He points out that this expected link between a higher beta and higher returns over time, it hasn't always held up perfectly in the real world.
Yeah, the theory doesn't always match what actually happens.
Plus, he says a stock's beta isn't set in stone.
It can change over time. Companies evolve, markets shift.
And even the market index you're using as a benchmark can affect that beta number. So while beta can give you a quick sense of volatility, it shouldn't be your only guide.
It's just one data point, not the whole picture.
Malkiel also brings up this intriguing alternative to that classic 60-40 portfolio split, 60% stocks, 40% bonds. He talks about risk parity.
Ah, risk parity. It's been gaining some traction in recent years.
It has. So instead of allocating based on just those fixed percentages, 60/40 or whatever, the idea is to allocate based on how much risk each asset class is actually bringing to the table. Since bonds are generally less volatile than stocks, a risk parity approach would probably end up with a larger chunk of your portfolio in bonds.
To balance out the risk from those stocks.
Right. And the idea is that this might give you a better balance between the risk you're taking and the potential return you're aiming for.
It's a different way of thinking about portfolio construction.
Now, sticking with bonds for a minute, Malkiel makes this point about a really big risk for bondholders: inflation. If inflation starts to heat up, it can push interest rates higher.
And when interest rates go up, the value of existing bonds goes down because investors can now buy new bonds with higher interest rates, making those old bonds less attractive.
Exactly. And inflation also eats away at the purchasing power of those fixed interest payments you get from a bond, and of course the principal you get back when the bond matures.
Your money buys less over time.
That's where these Treasury inflation-protected securities, or TIPS, come in.
TIPS are designed to be a hedge against inflation.
He describes them as a way to protect yourself, because the principal amount of a TPS bond is actually adjusted based on the Consumer Price Index, that's the CPI, which tracks how prices are changing for all those things we buy every day.
So as inflation goes up, the principal value of your TIPS bond also goes up.
Right, and because the interest payments are calculated on that adjusted principal, those payments also go up with inflation.
It helps you maintain your purchasing power.
He actually mentions that in the 2010s, long-term TPS had a basic interest rate of around 1%, but that 1% was applied to a principal amount that was changing with inflation. So if you hold those TPS until they mature, you're guaranteed to get your original investment back, plus an extra bit to account for inflation.
It's a way to make sure you're not losing ground to rising prices.
Okay, let's shift gears a little bit and talk about this whole debate about how rational or maybe irrational the market really is.
Ah, yes. The eternal question. Is the market driven by logic and cold, hard data, or by emotions and herd behavior?
Malkiel brings up that there were periods like in the 1970s, early 1980s, and maybe even the mid-1960s where the market's behavior seemed kind of out of whack with what was actually happening in the economy.
Those were some pretty turbulent times.
They were high inflation, high unemployment. And Malkiel says that during those times, investors' perception of how risky stocks were actually changed. They started to see stocks as riskier, which led to lower stock prices.
Interesting how perception can have such a tangible impact on prices.
Yeah. And it shows that the market isn't always driven by just pure fundamentals, but also by those collective feelings of fear and uncertainty.
Sometimes those fears can be overblown, sometimes they can be justified. It's hard to know in the moment.
It is. And then Malkiel goes on to recommend what he calls a no-brainer step for most investors, and that is putting your money in low-cost index funds.
Index funds have become so popular.
They have, and his argument for them is really straightforward. He says that over the long haul, these broad market funds, especially ones that track the S&P 500 with their super low fees, tend to outperform the vast majority of professional investors who are out there trying to pick individual stocks.
It's hard to beat the market consistently. Index funds are a way to just accept the market's return, which historically has been pretty good.
He even points out that he was making this argument way back in 1973. He was really pushing for these funds to be available and affordable for everyday people.
Years ahead of his time.
Okay, now let's dive into a world that's a little bit more high-tech, a little bit more fast-paced. We're going to Scott Patterson's book, Dark Pools. And this is where we get into the world of algorithmic and high-frequency trading.
This is where the machines take over.
It is. And it's a world where speed and complexity are everything.
Patterson starts by talking about the flash crash. This was back in 2010, and really showed just how volatile the market can become when you have these super fast algorithms all interacting with each other.
It was a pretty dramatic event. The Dow Jones Industrial Average plunged almost 1,000 points in a matter of minutes.
It was wild. And Patterson explains that these crashes, these flash crashes, are often caused by what are called self-reinforcing feedback loops.
Which basically means the algorithms start triggering each other. One algorithm sells, which triggers another algorithm to sell, which triggers another one, and so on. It creates this downward spiral.
And it can all happen in milliseconds.
Literally the blink of an eye. Patterson goes on to say that this whole landscape is evolving incredibly fast, driven by artificial intelligence. He suggests that even for seasoned professionals, it's becoming harder and harder to understand exactly what's going on in the market at any given time. He compares it to navigating through this dense fog.
Yeah. You're trying to make sense of all this data and these algorithms, but it's all happening so quickly that it's hard to get a clear picture.
And then he tells the story of this firm, Trading Machines. They were a super sophisticated algorithmic trading firm, but despite all their cutting-edge technology, they kept getting hit by these hidden errors in their code, which were leading to huge losses.
It just goes to show that even the most advanced players in this game are still vulnerable to the unintended consequences of these super complex systems.
And then there's this whole concept of order awareness that Patterson talks about. It's almost a euphemism for something that sounds a lot like statistical front-running. What happens is these algorithms are crunching massive amounts of market data, and they're trying to detect those big orders that are about to hit the market, the ones that aren't fully displayed. They're sometimes called iceberg orders because most of the order is hidden beneath the surface.
So the algorithm sees the tip of the iceberg and knows there's a much larger order lurking below.
Exactly. And once the algorithm figures out that there's this big order coming, it can jump in and execute its own trades just ahead of it, capturing these tiny little profits before that bigger order gets filled.
It's all about speed and information.
It is. And then Patterson takes us into the world of these algo wars, as he calls them.
The battle of the algorithms.
You have these hunter-seeker algorithms that are designed to find and exploit any opportunity in the market. And then you have these defensive algorithms that are trying to protect against those predatory strategies.
It's an arms race.
It is. And it's expensive. Patterson mentions how firms like Trading Machines were spending literally millions of dollars each year just to make their systems a tiny bit faster.
Tiny fractions of a second can make a huge difference in this world.
He also explains how most exchanges use this maker-taker model. In this system, traders who provide liquidity, which means they're placing limit orders, the ones who are making the market.
They're essentially saying, I'm willing to buy or sell at this price.
They actually get these little rebates. While the traders who are taking liquidity, who are hitting those limit orders, the takers,
They're the ones who are saying, I want to buy or sell right now at whatever the best available price is.
they get charge fees, and the whole idea is to encourage more trading, which is good for the exchange.
But it also raises questions about whether the system is always fair to everyone.
Especially for those slower-moving investors, like those big mutual funds that are placing those large trades. They might end up indirectly paying a bit more in fees.
Because they're often the ones taking liquidity.
Patterson then dives into the murky world of these special order types that some firms have access to.
Sometimes called zero-plus specs.
He suggests that some firms might be using these specialized orders to kind of skirt around regulations like Reg NMS. And these regulations were actually designed to make sure that everyday investors are getting the best possible prices when they trade.
So are these special order types creating an unfair advantage?
Patterson uses the experience of this trader named Bodek. He was losing money, and he switched to using these insider orders to basically stop the bleeding.
It's an example of how complex these regulations can be, and how sometimes they might create loopholes that sophisticated players can exploit.
Then Patterson takes us way back to the early days of automated trading with firms like Daytech, and he talks about this guy, Josh Levine, who created Island ECN, which was one of the first electronic communications networks. And this was a game changer because it allowed buyers and sellers to connect directly, electronically.
It cut out the middleman, the traditional market makers.
And that paved the way for the whole explosion of automated trading algorithms.
This is a revolution.
It was. And then you had these other ECNs popping up, Archipelago, Instinet, and it became this race to be the fastest.
And to offer the biggest rebates to attract those high-frequency traders.
Patterson also touches on some of the shadier aspects of this world, like concerns about people stealing trading code. He talks about this case involving Sergei Alanikov at Goldman Sachs.
It shows just how valuable those algorithms are. They're like the secret sauce.
And he wraps up by talking about the potential conflicts of interest that can arise between the exchanges and these high-frequency trading firms.
Yeah, it's a complicated relationship. The exchanges need those high-frequency traders to generate trading volume. But they also have a responsibility to make sure the market is fair for everyone.
Okay, let's take a sharp left turn here and go to Martin Pring's book, Technical Analysis Explained. Now, this is a completely different approach to trying to understand the market.
It's all about reading those charts, looking for patterns, trying to anticipate where the market might be going based on where it's been.
Right. And Pring emphasizes this idea of being a contrarian. He says successful technical analysis is often about betting against the crowd.
Going against the prevailing sentiment. Buying when everyone else is selling and selling when everyone else is buying.
Which sounds pretty scary, to be honest. But Pring says that the crowd is often wrong, especially at those major turning points in the market.
That's when the big money is made, at least in theory.
One of the basic concepts Pring talks about is this idea of peak and trough progression.
It's a way to identify the overall trend of a market.
He says there are three types of trends. You have the primary trend, which lasts for a year or more, and that reflects how investors feel about the long-term economic outlook.
So if the primary trend is up, investors are optimistic. If it's down, they're pessimistic.
Then you have intermediate trends, which are basically corrections within that primary trend.
Yeah.
They're shorter term.
They're the ups and downs within the larger trend.
And then you have short-term trends, which are those day-to-day fluctuations.
Those can be really noisy and hard to predict.
Pring also gets into Dow theory.
One of the oldest methods for trying to figure out the primary trend.
It looks at the direction of both the industrial and transportation averages.
That was originally the Dow Jones Industrial Average
Yeah.
and the Dow Jones Transportation Average.
Right. And the idea is that you need confirmation from both averages to say that a new primary trend has started.
So both averages have to move in the same direction, and they have to break through those previous highs or lows.
And Dow theory also stresses that you need to look at volume, and that trends tend to continue until there's a clear sign that they've reversed.
So don't try to fight the trend.
Then Pring gets into all these different chart patterns. You have island reversals, which are pretty rare but can be really significant signals of a change in trend.
They're called island reversals because they look like little islands on the chart.
He also describes saucer formations and rounding tops. These suggest a more gradual reversal.
Where the volume tends to dry up in the middle of the pattern.
And then you have key reversal days, which happen when the market makes a new high or a new low, but then suddenly reverses and closes near the opposite end of its range.
And that reversal usually happens on heavy volume, which suggests a shoot in sentiment.
Trend lines are another big part of technical analysis. Pring explains how a rising trend line, which connects a series of higher lows, can act as support for the price, while a declining trend line, which connects a series of lower highs, can act as resistance.
And when the price breaks through one of those trend lines, it can signal a potential reversal.
But he does say that drawing trend lines isn't always an exact science.
It involves some judgment. Different analysts might draw those trend lines slightly differently.
He also talks about moving averages.
Those are used to smooth out the price fluctuations and try to identify the underlying trend.
And when the price crosses above or below a moving average, that can be a signal of a potential change in trend.
But he also warns about whipsaws. Those are false signals that can happen when the price is bouncing around near a moving average.
And he talks about using advancing moving averages to try and filter out some of those false signals.
That's where you only pay attention to signals that are in line with the direction of a longer-term moving average.
Then there are these things called momentum indicators. Pring talks about the rate of change, which is ROC, and the relative strength index, which is RSI.
These are ways to measure the strength of a trend.
He introduces this concept of divergence, which is when the price of a stock is making new highs or new lows, but the momentum indicator isn't backing it up. That suggests the trend might be losing steam.
But divergence by itself isn't a clear buy or sell signal. You need to look at other indicators to confirm.
He also talks about breadth indicators, like the advanced decline line.
That's the difference between the number of stocks that are going up and the number that are going down.
And he says if the advanced decline line is diverging from the price of the overall market, it could mean that the market move is being driven by a smaller and smaller number of stocks.
Which could be a sign that the rally is getting tired.
And then finally, Pring mentions some of those seasonal patterns in the market, like the January effect, and he introduces this thing called the Kondratiev cycle, which is a super long-term economic cycle.
Like 50 or 60 years.
Okay, let's get to our last book, Benjamin Graham's The Intelligent Investor. This one is all about value investing, and Graham starts by making a distinction between investing and speculation.
He says investing is about buying something after you've done your research and you believe it's worth more than you're paying for it, while speculation is more about trying to time the market to buy low and sell high.
And Graham is very clear that he believes in investing, not speculating.
He's all about understanding the underlying business, the fundamentals.
Graham looks back at the history of stock and bond returns, and he makes this interesting point about the huge gains that stocks saw after World War II. He suggests that a big part of those gains might have actually been driven by this change in how investors were thinking about risk. They were more willing to take on risk after the war.
And they were willing to pay more for stocks. So it was this self-fulfilling prophecy. More optimism led to higher prices, which led to more optimism.
Exactly. And he warns against assuming that those really high returns will continue forever. He says you can't just look at the past and assume the future will be the same.
Especially if those past returns were driven by, like you said, a change in sentiment, rather than a real improvement in those underlying business fundamentals.
Then Graham gets into bonds. He talks about different types of bonds, including state and municipal bonds, which have this cool feature. They're exempt from federal income tax.
That can be a big advantage for investors in higher tax brackets.
He recommends that the defensive investor, who is primarily concerned about protecting their money and not losing it,
They're not chasing those big returns. They just want to keep their money safe.
they should focus on high-grade bonds. He also mentions preferred stocks, and he says they often get a more favorable tax treatment for corporations than for individuals.
It's all about understanding the nuances of different asset classes.
Then, when it comes to common stocks, he defines growth stocks as those companies that have a history of really strong earnings growth.
And the expectation is that they'll continue to grow rapidly in the future.
But he also points out that growth stocks often come with this speculative element because you're paying a premium for that expected future growth.
You're betting on the future.
So for the defensive investor who wants a really simple, low-maintenance approach, Graham recommends a diversified portfolio with a limited amount in those high-quality stocks and a larger portion in those safe bonds that we talked about. He even suggests that these investors should think about using a low-cost brokerage.
Keep those costs down.
And he says if you don't have the time or the desire to be actively managing your investments, it might be a good idea to find a financial advisor.
But he's very clear that you need to understand how that advisor is getting paid and what their philosophy is.
He says you need to make sure you're on the same page.
Yeah, absolutely. And he warns against advisors who might freak out and sell everything after a year or two of bad performance.
Which goes against the whole idea of long-term investing.
Right. Don't panic.
Graham also makes this interesting point about how the market tends to undervalue smaller, lesser-known companies, what he calls secondary companies.
So there might be opportunities to find some hidden gems there.
But he also says that during those big market booms, it can flip, and investors can get really excited about those less established companies.
And that can lead to those bubbles.
Graham is a big advocate of this idea of buying low and selling high, but he's very clear that it's much harder to do in practice than it sounds in theory.
It requires a lot of discipline. You have to be able to go against the crowd and to resist the temptation to buy when everyone else is buying.
He also looks at the performance of investment funds, and he says that a lot of them actually fail to beat the market consistently.
Which kind of goes back to Malkiel's point about how difficult it is to beat the market consistently.
He also warns investors about looking at these pro forma earnings, which can be misleading.
Because they might not include all of a company's expenses. They can paint a rosier picture than reality.
He uses examples of accounting shenanigans. He talks about Quest Communications, and he talks about companies that showed huge revenue growth but weren't actually making any money, like Expeditors International in its early days.
It highlights the importance of doing your due diligence. Don't just take those numbers at face value. Dig a little deeper.
He also talks about how some industries are cyclical, like the railroad industry. And he points out that even companies that seem really solid can fail.
He mentions Penn Central.
So he's really stressing the importance of understanding the underlying business.
Don't just focus on the stock price.
And then he describes what he calls the aggressive investor. This is an investor who is willing to take on more risk, to look for those undervalued companies that other investors might be ignoring.
They're willing to do more research, to dig deeper.
But Graham emphasizes that even for the aggressive investor, it's still crucial not to overpay. He also talks about convertible securities, which can be really complex.
They could be a way to get exposure to a stock with some downside protection, but they also have their own risks.
It's fascinating how all these different ideas connect, right? Like you could use those technical analysis techniques to try and spot those times when the market is getting too optimistic or too pessimistic, and then use Graham's value investing principles to decide when to buy or sell.
Yeah, you could use technical analysis to try and time your entry and exit points.
And understanding how those high-frequency traders operate in dark pools might make you a bit more patient as a long-term investor. You'll be less likely to react to every little blip in the market.
Because you'll know that a lot of that short-term noise is being driven by algorithms.
Right. So I think the big takeaway here is that there are many different ways to approach investing. But no matter which approach you choose, there are some fundamental principles that apply.
Like the importance of diversification.
Right. Spreading your investments around and understanding that risk is unavoidable.
And that past performance is not necessarily a guide to future returns.
And also that the market can be irrational in the short term, but over the long term, it tends to reflect the true value of businesses.
So don't get caught up in the hype.
This has been a pretty intense deep dive.
It has a lot of information.
So here are a few key takeaways. First, diversification, spreading your investments around, is still crucial, even in today's globally interconnected markets.
Definitely. Don't put all your eggs in one basket.
Second, beta can give you a quick sense of volatility, but don't rely on it as your only measure of risk.
It's not a perfect predictor of future returns.
Third, algorithmic and high-frequency trading have completely changed the market.
It's a whole new ballgame.
Fourth, technical analysis can be really helpful for understanding market trends, but use it with a healthy dose of skepticism.
Don't just blindly follow those chart patterns.
And finally, embrace a disciplined, long-term, value-oriented approach to investing. It's like Graham says, be an intelligent investor.
And here's one final thought for you to chew on. In this world of increasingly complex and fast-moving markets, what are the core principles that you should hold on to navigate all of this and build a solid investment strategy for the long term?
That's a great question, and it's something we all need to be thinking about. We hope this deep dive has given you some food for thought.
And maybe even some actionable insights.
We encourage you to check out these books for yourself and continue your investing journey.
Keep learning, keep exploring.
Thanks for joining us on the deep dive.
We'll see you next time.